Um, Good evening, good afternoon. Again, we had the other session, but unfortunately it closed, and we are still going live again. And so, as we wait for others to join, we are going to start, by understanding what we are going to learn today. There is one thing that you should understand. There is a difference between what is outside there and what to expect. What is outside there is the selling of a dream that once you are inside it, you come to understand that it's kind of another thing, and it's more, you can call it even that it's a lie. You are allowed to call it that way, but in real sense we were sold a dream that is um kind of fake. The dream was sold so that we can purchase the seller's courses, and that is what happened. And so today we are going to talk what is literally expected, like what is and what should be there. And so as we're starting this, make sure to also subscribe so that we can um get to a point where these such sessions um uh can be beneficial, or can reach other people who may not have been recommended by with YouTube. You can also share it with a friend who didn't purpose to join this session. This session is recorded and will be left on YouTube. And so as we start this session, make sure to have somewhere to write, so that you can get to understand it, and you can use the tools for the later periods. And so as we start, just stick in and concentrate, because these are the sessions that you need. Instead of you going to watch 100,000 YouTube videos on beginners class, you can just start with a session like this. And let me tell you, once you apply what you have learned here, next week you are good to go with technical analysis. Even though we'll be having the technical analysis class tomorrow, the technical analysis class is more of after you have understood the beginner session. Now, how do you now apply? Let me tell you something. The beginner session is more of, just preparing you for what is about to come. This is nothing. You will never meet whatever we learn here on the real charts. The good thing with trading is more of it is not a career where you are being asked like you are being tested on what you learned. You're being tested on what you practice. That is the difference between trading and other career. You can learn this within a week, then you practice the right thing within a month, and the next month you start making bag out of it. The people that do waste time, and the beginning of my career, how I wish that I had such a session. And so as we start, let's continue to send the link to our friends. You can ask any question on the chat box. Let me make sure that it is enabled. You can ask any session in the chat box. You can also if you are on the wise people mentorship group, you can just text your question there and we might get it answered here. And so as we start, actually let's start, let us say as we start, because I'm very sure we are around the starting period. We are starting in a minute. Actually, I wanted to be as precise as possible so that we do not waste time on these things, because beginner, this is a session that you only need like 1 hour, if maximum 2 hours, and the 2 hours is just to add on you seeing what we are learning here as beginners, because what there are things that we will come to understand that later, after some time. Let me do something. Now we will come to understand that after some time, that whatever we learned is supposed to be practiced, because we are mostly going to talk about how do we call it, we're going to look at more of uh definitions of certain terms. Like for example, does someone mean when they say margin, they say equity, they say balance? That is common English. But how does it now apply to forex trading? And so remember, on the beginning of as we were creating the group, we termed it as forex trading because that is how it is noticed. But let me tell you, this is not forex trading. This is more of a digital trading. Like we are looking at trading, but on a digital manner. We are trading against currencies. We are just buying and selling of currencies. That is what we are doing. But I term it as forex because that is how most of the people know it. But it is not that way. It is just a digital um, trading. This is a digital market where we exchange money digitally. A long time ago, it used to happen. You call your broker, you place a trade, you send them money, they do take it and put in real markets. Then the market stays there. If the market goes well, they will now send the money back to you. That was a hectic, but nowadays it became as simple as long as you have an Android phone that can install MT4, MT5 that we are going to talk about, you can now trade. As simple as that. But there was a time that it was not as that. Now this is to make you understand that there is different parts of trading. There is the career section, there is a business section, and there is the making money section that we are being told most of the time. Making money section, you just take your $10 and you flip to $100 within a trade, and you're out of that. We're going to talk on all of that because once you capture the those three methods, then you can make bank out of it. But if you capture one, then you're going to fall for the bad side of it. And so we're going to start. And so what is actually this thing that we call forex? Forex is usually abbreviated as FX, derived from foreign exchange. It means simultaneously buying and selling of currencies. For example, you if you have ever traveled from one country to another, then it means you have traded the forex market. But if you have not, then this is just the simple definition. For example, in Kenya, I come from Kenya, then I go to Nigeria. I can't be allowed to use the Kenyan currency in Nigeria, so I have to exchange my money with the current rates in Nigeria. So you'll get there is a current rate of exchanging Kenyan shillings to Nigerian shillings. There is a current rate, but um uh so when I come from Kenya, I'll take, for example, let me say I have 10,000 Kenyan shillings. I'll go to Nigeria. In Nigeria now, 10,000 one Kenyan shilling is around 10 Nigerian naira. That is just an estimation, but it's around that number. So I'll take that 10,000 Kenyan shillings and I'll change it to Nigerian naira. With it being one Kenyan shilling is 10 Nigerian naira, now I'll have 100,000 Nigerian naira. That is already forex trading. Now we will come to understand why, if that we have such small numbers, then how comes there are people that get to the bigger numbers with this career. Now, as long as people will continue to travel from one nation to the other, the exchange of one currency with the other will continue to happen. This is therefore erase the doubt of mine about the lifespan of forex trading. The people who think like for example, if you're in Kenya, you do understand that we have investment platforms that come and go. For example, there is one that is common currently, and we are in a phase where people think that it will go. I won't mention the name, but people think that it might go. So even when you're coming to the forex market, you think that this is something that you might deposit your money, then after some time it goes. Now what might go is the broker, but the forex market can't go. So there are brokers that are regulated, and we will talk about that. There are brokers that are regulated that can't go. Now those are the brokers that will be advised to use, and we'll also talk about that in this section. Forex trading will also will always involve two currencies at a time. It goes a long way to give indication of the strength of the currency under consideration. Now, for example, when we are trading the Kenyan currency with the Nigerian currency, as I told you, we'll be moving from one country to another. There is a time when we are in Kenya, the Nigerian currency will have it as one Kenyan shilling is equals to 15 Nigerian naira. There is a time that will go down to 9 naira and so on and so forth. Now, those fluctuations is what now we trade them. We buy when the price is lower, then we sell when. For example, I have 10,000 Kenyan shillings and I want to go and trade it with the naira. So what do I do? For example, I come to the market and I find that one Kenyan shilling is around 9 naira. So I buy with the 10,000 Kenyan shilling those naira, and I'll have 90,000 naira. I've bought small. Then let's say after some time I come back and I see the Nigerian market, one Kenyan shilling is equals to 15 Nigerian naira. Now I'll sell those. I'll you see those 90,000 naira that I had, it will be now. Actually, let me tell you what we're doing. We are taking the Nigerian naira and we're selling. Like we're buying small and we're selling high. For example, if you are buying a Nigerian naira at 90,000, then you can sell it. You buy the Kenyan shillings at 90,000 Nigerian naira. Then after some time you see that one Kenyan shilling is around 15 Nigerian naira. Then you take the Kenyan shilling and you exchange it to naira at that current rate. Now you bought the Kenyan shilling at 90,000 naira and you sold it at around 150,000 naira. Now you have a profit of, you know, do your maths, but it's a very nice profit of around 60,000 Nigerian naira, which you can also change it into Kenyan shillings, and you will have the profit in the numbers of Kenyan shillings. Now, that changing and exchanging currency is now what we term as the forex exchange. Now, the framework which I'm bringing now is what used to happen long time ago. But when we got into the digital market, we don't notice the changing. We don't notice the changing. But what we notice is the fluctuation. Like I'm in profit of this number, that number. That is what we notice. But that is what, like that, those were the terms of long time ago. And when I'm talking about long time ago, I'm talking about 1950 and below. After 1950, now we started having trading desks where we're dealing with brokers. Now that was the rise of brokers from that time. And after some time, now we started experiencing changes. Technology grew, we went to the digital market. Now you can't notice the exchange because you won't see your account balance. When you buy USD JPY, you won't see your account balance in JPY, then in USD. Now you will see it as USD, but the fluctuations do happen. Now that is what is happening. Now the next section, the next page, market participants. Now here we are talking about who are these that move the market in forex trading. Now this is also to prove the legitimacy of forex trading, because yeah, I know we have been sold the bad dream, the bad part of forex trading, that uh um this is more of, you know, uh making money and so on and so forth. But there is something that you should understand as a beginner. The different players involved in the forex market: the central bank, commercial bank, hedge funds, brokers, speculators, individual, etc. Now, central banks, in every country we have a bank that, you know, houses all the banks. Like this bank is how do I call it? Like it regulates all the banks in that country. For example, you know, a bank can be someone that can just come up and create his own bank. The banking system is not limited, meaning if you have the knowledge, you can just come up with your own banking bank. But you have to be regulated by certain people who make sure that the bank that you're opening is very legitimate. Like everything that you are saying is, you know, everything that you are owning, everything that you're bringing them now is very legitimate. Now that is at the central banks. Also, the central banks are the ones that hold the money that comes into the country. They're also those that manages, the funds of the country, in conjunction with the treasury. That is for Kenya. But just know we are talking about central banks. We are also talking about commercial banks. Commercial banks, now these are these local banks that we are talking about, which are housed by the central banks. We also have hedge funds. Hedge funds, now these are funds whereby they do take people's property money and they do manage it. you know for example, you have, like, let's say 50 million and you wish to invest it. Now you will go to a hedge fund and you can give them, that is an option. Then after you giving them, now they can invest to you, meaning they're dealing with very heavy money, and they are also trading the markets, and they also move the markets because they have a very large amount of capital. Brokers are now the ones that connect retail traders with the market, because retail traders can't access the market directly. Because remember, as a retail trader, even if you have $1 million, you are a retail trader. The market is traded of the market cap of Forex is around 6 point something trillion as we are speaking, and it is continuing to grow as time goes by. Meaning, this is something that at one point we'll be talking about 10 trillion. We'll be talking about 20 trillion. Now, with your $1 million, and remember, $1 million, those who are trading $1 million are among the richest traders. But let's now speak about the real numbers. Your $100, okay? Your $100, you come with it to the market. Do you think you can now go to the market whereby someone is trading 6 trillion, 1 trillion, 2 trillion? No. Now you need a broker who takes a request from many traders and he combines those money. For example, 100 trillion, my friends, $100, my buddies, $100. And once they take those money, now they can trade the market. But as for you, you won't notice that. You will be placing the trades because the reason behind technology improvement was to make everything easy. Now they don't want to overcomplicate things. So what do? They just give you the real numbers, what is going on, but they are the ones that are doing the work. Speculators and individuals, now these are the retail traders. Now it is worth to note that retail traders account to 3% of global participation. Therefore, advised to follow the big money movers in the market and never try to go against them. Now, the retail traders participate in, let's say, the 3% of the 6 trillion. Okay, now remember, we are talking about a market mover who is of around uh 1 trillion. Now this market mover moves the market his direction. Now these are the things that we are looking at. Now you are advised to go to with the follow the movement of the big money, the one who is trading with the big money, the banks, the hedge funds. You are now advised to follow their movement. Now that is the purpose of strategy. When you're trading strategy, remember, these big money movers, they were once retail traders, or every concept that the retail traders do have was originated from these big money movers. They are the ones who brought this concept. Now, this concept were published from long time ago. There are people who came down, understood it, and now converted and chew for us so that we can be able to swallow it as simple as possible. Now that is what we term as strategy. Strategy is how you approach the market. So it means your strategy should be as it was traded in the 1950, because the market doesn't change, the market just improves. That is one thing that you should know. Okay, so after market movers, now we are talking about, you know what is GBP, USD, Euro, USD, etc. When you have, for example, I'm very sure if you know about Forex, you've seen someone saying that they do trade and this pair, that pair. For example, personally, I only trade oil, which is XTI USD, or sometimes WTI, Western Texas Intermediate, against the USD. Now, what are these? These are just currency pairs. They can be metal pairs if you're trading gold, which is XAU USD. They can be commodity pairs if you're trading what I'm trading, oil. They can be indices if you're trading things like US 30 and so on and so forth. Now, those are, so they are not just complicated things. Now, why do we need to combine the two pairs? Remember, in order to know if a country is improving or not improving, we need to compare it with another country. For example, how do we know that the US is failing? How do we know that the US is improving? If we compare it with the Great Britain pound, or if we compare it with the euro, you see, that is how we know that this currency is improving or it is not improving. Now, that is the main reason why we have them in pairs, meaning so that we can have those change in the market, we must have two pairs, that one is fluctuating and the other is not. The other one is stagnant, the other one is moving. Now, that is how we trade it. Now, if you can see the diagram below, we have euro stroke USD. The euro, which is always the first pair in each currency pair, is the base currency, and then the next pair is the quote currency. The base currency is the pair that is the pair that we are speaking about. Like, for example, we are comparing in this example, we are comparing the euro against the USD. We are looking, our main focus is on the euro, you see. So we are looking if the euro is improving or improving in relevance to the USD. As we continue, we will start learning something called how do you correlation, something like that, whereby we are talking about when how do we speculate the improvement of USD against the euro in such a currency pair. You see, the euro is the base currency, the USD is the quote currency. Now we're comparing the euro against the USD so that we can conclude if the euro is improving or not improving. That is the main reason. You see, that is how we do it. In this case, the first currency is the base, while the other currency that appears in the back is the quote currency. The quote currency serves as a reference point to determine the value of the base currency. Just what I explained, or I had explained. If the current currency, if the current price of euro USD is 1.20000, it means that for every 1 euro you need $1.200 to buy it. Hope that is as clear as it is. Now to the next slide. Essentials of trading. Now these are what you need as a beginner to trade. As long as you are in this session, after this session, make sure you have this on your phone or on your computer. Now, the first thing, you should understand the market hours. You should understand at what time does what trade and why does it trade at that time. Now, we have 4 market hours. We have the Sydney session, we have the London session, the New York session, and we have the Tokyo session. Now, let me line them as how they should be. We always start by the Sydney session, then we go to the to the Tokyo session, then the London session, and the New York session. When the sessions are continuing, have times whereby the Sydney session and the Tokyo session start, the London session and the New York session start at the same time, or as the London session is continuing, then we have the start of the New York session. That is what we have. Now, why do we have these market sessions? It is as simple as the London session does start when it's a new day on in London. London is in UK, Great Britain, actually in Britain. When we are in the morning in the Britain, the banking hours, for those who have used the bank, we have the banking hours. Now, that is the time that we have the London session. Remember, even as the London session is continuing, if you if you did study geography, we will have around as the London session continuing, now we will have the morning in New York, which is in the US. Now we'll have morning at that time. Now we'll have a period where um GBP is being traded highly and USD is being traded highly. Whenever we have the London session, it means GBP is being traded highly. At that time, we have people exchanging their GBP currency to other currency. We have people changing their other currency to GBP and so on and so forth. And during the New York session, now we have people trading USD very heavily. Even the banks are also now trading the USD at this time. During the London session, the Sydney, which there is no particular pair, but Sydney is in Switzerland. I think so. Is in Switzerland. Now at this time, the AUD is being traded heavily, and yeah, AUD. Now during the Tokyo session, now it is in Asia. JPY is being traded heavily. Things like also AUD is being traded heavily, because if you can see something on the chart, during the Sydney session and the Tokyo session, they just overlap with 2 hours. Just 2 hours. When the Sydney session starts, after 2 hours, we have the Tokyo session starting. When the Sydney session ends, we have 2 hours. Then the London session continues. We only have 1 hour whereby the Tokyo session and the London session is being traded. Now, we will come to see the relevance of this, because I'll tell you something. For example, if you get to short time trading, which is called scalping, I'll tell you, during the when London session and New York session is overlapping, whereby you have the London session and the New York session going at the same time, you should be trading things like GBP USD at that time. When Tokyo session and London session is overlapping, these are times that you should be looking at GBP JPY. When the New York session, when the Sydney session is trading, you should be looking at things like, or Sydney session and Tokyo session are overlapping, you should be looking at things like, you know, AUD JPY, AUD CHF. Actually, CHF is the most traded pair during Sydney session. That is the currency pair in Switzerland. Now, we will understand that as time goes on. But now you should understand we have four trading sessions. We have London, New York, Sydney session, and Tokyo session. Now, as we continue, we will come to digest these things. These are just the beginning sessions, and they make it look hard, but at the end they are simple. They are just simple. Now, the next part, brokers. I think I had explained brokers as we continue. So these are firms that provide traders access to trading platforms where buying and selling actions are completed. These are just people that brokers in layman's language. These are just people that connect you with something. But in this example, they are connecting you with the market, because you can't trade the real markets. Since how can you take your $100 and communicate in an area where people are trading $1 trillion and above? Now, these are the purpose of brokers. As we explore the world of Forex, I urge you to choose a broker that gives you minimal cost on your transaction and quicker returns on your investment. My preferred broker was FB Markets, but currently is Deriv, and we have a reason for that, and I'll also give you a session on Deriv. And let me give you just a preview on Deriv. Deriv does have different trading. We have trading synthetic indices whereby you can trade on Saturday and Sunday. The forex market only runs for 24/5, meaning it runs for 24/7, but from Monday to Friday. On Saturday and Sunday we don't have trading sessions, but if you want to be a full-time trader, you might need to trade on Saturday and Sunday. Now you can now jump to synthetic indices, which go from Monday to Sunday. Another thing, synthetic indices, you can use to trade them if you have capital as low as 0.5 USD. Deriv also allows you to deposit as low as $1. You see, it has very many benefits for beginners. Now, I'll give you a session on Deriv and give you a link on which you can join Deriv and have very many bonuses as you trade there. Now, the next section, spread. As we be trading, there is something called spread, because remember, we are talking about price. And when we are talking about price, what we are seeing on the forex market is banks, hedge funds, institution giving their bid prices. They are giving they are more of giving their suggestion on price, and now we have the a price on which the broker will open and close the trade at. The bid price is mainly connected with the banks, and the ask price is now connected with the broker that you're using. Now, the significance of spread, the brokers that have a very large spread. Imagine, for example, you have a bid price of um let's now use the layman's language. I have a bid price. The market price is, um 10 dollars, but I, as your broker, come and tell you now, if you give me $15, then I'll go and, you know get the thing for you and bring it to you. Now the difference is that the market price is $10, but we have different brokers with different ask price. There is a broker that, when the market is $10, there's a broker that will tell you, now I'll just go for you, I'll just go get it for you with will go and give you with the will go and give you uh the price at $12. There is a broker that will tell you at $13. There is a broker that will tell you at $15, $17, so and so forth. But there are brokers that will tell you, I'll go for you at, $11, because they have to, get some profit with that spread. Because imagine me being a broker, but you want, the bid price, the price that the banks are giving is $10, but you want me to still give it to you at $10. You see, that is not conversant. I'm a broker. It means I should be making money in every transaction you make. Now, there are brokers that will give you as low as $1, and that is derivative. So deriv has tight spreads, meaning it has reduced prices on that different price, meaning on every trade they just take a small percentage. Now there is also something called commissions. Commissions is different on spread. Remember, when I said that in the market, using the literal numbers, in the market we have the price at $10, but the broker will give it to you as, if you want to get into the market, you have to, give me $11. You see, but there is something called commission. You see, when you open that trade, it means the broker will only earn the money once you are out of the trade. Meaning, if the trade takes, 10 days, 20 days, the spread, that price, that, that fluctuation, that $1 won't be, will take some time before they take it. So there is brokers that do offer commissions. Commissions is when you open the trade, they take some amount of money and they hold it. You see, the brokers that offer as low as $3 per lot, we will also talk about lot in this section. Now, once you open the trade, they take some amount and they hold it. They won't give it back to you. That is just their commission. Once you open the trade, they take it and they hold it. But during the spread, remember, every broker has spread. The difference is there are brokers that have tight spreads, there are brokers that have wide spread. Now you have to go and look for tight spread because of something that we learn in maybe tomorrow's session. So commissions are we what brokers take once you open the trade. Now there are brokers that don't have commission, but they have large spreads. There are brokers that have commission, but they have small spread. Now it will determine which one fits your description. Now the next section, pips and point. In forex, for example, this is the market moving at uh, moving a certain distance. Remember, when we are, let me just use that example. Let's say I'm moving from here to somewhere like Tanzania, and there is from here to, Nigeria. We have difference in kilometers. You see, now in forex we measure the movement in terms of pips or points. Pips is point in percentage. For example, if we are 1 pip, that is 10 points move. You see, when we are 2 pips, that is 20 points move. 3 pips, 30 points move. Pips, points in percentage. But as we continue, you will come to realize points nowadays, they are more of left out, because we now want to reduce the numbers. Because if, for example, if you want to talk about 100,000 points, you see, when I convert it into pips, those are just 10,000 pips, and it is simpler that way. Now, if you can see that example down there of euro USD, how to measure pips in them, the last number is point, or rather a pipette. That is a point, but it is called a pipette. Now this is just a small, that is, for example, centimeters. Then we have meters, kilometers, and so on and so forth. But now the last number is pipette. The other numbers are pips. Now we have 1 point. For example, if you can look, we have 1.0992. Then we have 1.0994. If the market moves from that 1.0992 to 1.0994, we have moved only 2 pips. You see, when the market moves from 1.992 to 1.994, we have moved only 2 pips. Now, as we continue to understand, you will understand that there are markets that, for example, if you are trading pairs that have JPY, we don't have 1 point something, because JPY, as you understand, if you compare USD JPY, we are talking about 180. 1 USD is equals to 180 Japanese yen. We are talking about those numbers. Now remember, if we have 180.0000, that is not making sense. But if 180.012, that is making sense. We are talking about cents. That is how it is. So when you are continuing, you will see that there are pairs, for example, GBP. Whenever we are talking about GBP, JPY, actually the only exception is JPY. Whenever you are comparing JPY with any pair, we'll have only 3 numbers after the decimal point. But whenever you are comparing any other pair, we'll have around 5 numbers after the decimal point. As we continue on, we will understand how do we calculate the pips, because that is something that should be shown in the charts. Now, the next point, lot. We were at one time I was talking about commissions per lot, $3 per lot. Lots is, remember, we were talking about forex being a field where large money is being purchased and bought, sold, exchange, traded, and so on and so forth. Now, you have your $100, okay? So how is it measured in the market to an extent that you can enter that $100 without it being viewed as $100? Because $100 can't move a market that is moved by 1 trillion. We're talking about a market cap of 7 trillion. Do you think $100 can make a difference? Absolutely not. So we are now looking for a way of combining lots. Now that is how the brokers will take your money and calculate it. This is more of when you're investing in something, what is the percentage return on it? For example, you invest in a house, you and your friend, you gave out 60%, your friend gave out 40%. But if you are talking about money, this 40% could be 1 million, 2 million, and your 60%. You see, that is confusing. Now we reduce it to a number that is that is understandable by everyone in the markets. Now, this is how that is the definition of lot size. Lots are just units. Like when we want to buy something, we buy it in unit form, but this unit represents a certain value. unit per size. For example, I want to buy 5 gbp. I want to long, for example, and I want to long with 5 USD. Now remember, when we are longing with 5 USD in GBP USD, it means you should be trading using the GBP pair, but you want to, the broker to open that trade using your USD pair. Now the broker will go buy a unit which is like a standard size, will buy a unit with that, then you will use it to trade the market, then he will come and sell that unit and give you the whatever you made. You see that, like, it's just like a bag for carrying your 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 trade. Remember, for example, there was a time that we used to trade barter trade. I come with my cow, you come with your beans, and we trade it. But it was inconvenient because, remember, I can come with my cow and you can come with your beans. You come with your beans, and when I compare it with my cow, it seems like if I give you my cow, you will be the one at benefit, because I can't split the cow. I can't, split the cow into parts, then give you it, and you need a full cow. You see, now that is where money changed it. For example, if I want to buy a cow and I have beans, what do? I go and sell the beans, get it in money form, split the money into, or rather, if I want to buy beans, I'll take my cow, go sell it. Because remember, cow, if you compare a cow with beans, that then it means that beans has a low value as compared to cow. Then I take the amount that is conversant for buying beans and I go buy it. That is how lots work. Now lots in the market work as money. They're just like a middleman. You go buy it. Once you buy it, it goes and trades, and in the exchange of this and that, then you get it. Because remember, in the forex market, we are trading GBP USD, and your account is maybe in Kenyan shillings. Your account, you have put your balance in Kenyan shillings. Now how can you trade GBP USD with Kenyan shillings? You see, that is, it's not making sense. Now a broker, you will put a certain number of lot size. Your broker will go and buy that lot, put you into the market. Once you make profit or loss, he will sell that lot, then give it back to you with the profit or loss. That is now the simple definition of lot size. And so leverage, as you're trading, remember, we are talking about a market where we are talking about 1 million, 2 million people having tens of thousands of US dollars, and you're coming with your 50 US dollars, with your 100 US dollars. Now there is a way that your broker will push you will use your will enable you to enter the market with the small money. In other words, leverage is borrowed funds in order to scale up investment capital for potential results. Let's say you have $50, and in real sense, the forex market has a certain limit. Like, you have to have a certain amount so that you can enter the market. That is how it is. So what the broker does with your 50 USD, for example, you took a leverage of 1:1000, because leverage are in terms of 1:1:2. For example, we have 1:50, meaning for every dollar you have a buying power of 50 USD. For every dollar in 1:1000, you have the trading power of 1:1000 USD. Meaning, if you have 50 US dollars with a leverage of 1:1000, you have the buying power of 50,000 US dollars. Now that is the work of leverage. When you enter the market, the broker lends you the leverage, you trade with it. Once you get out, the broker takes the leverage. You see, he takes that money that he lended to you, meaning you will never see it, but you will see it in numbers. This is just the game of numbers. So the next thing, we have equity. Equity is more of balance plus floating profit stroke loss. Nothing excess, nothing very complicated in that. We will see these things in a very real field as we continue. Now the next part, margin. This is the amount of money put down as collateral for running positions. Margin call is when the broker notifies you that your account is about to blow. Now, margin is more of, remember, you are using your 50 USD to enter the market. Meaning, if you have a leverage of 1 is to 1000, there is a limit, there is a margin that you can buy. You can buy from, 50 USD to 50,000 USD. You can't go above that. Now, there are people that go full margin. Going full margin is you use the lended amount, all of it. You see, once you go on full margin, for example, if the trade goes against you, now you'll go to margin call. What margin call is, remember, when the broker is lending you the money to get into the market, this is real money. And it means when you are on loss, they are also losing that money. And remember, this is just money that they lended to you. Meaning, even if they lose, they won't take it from you. This is just like a collateral. This is like an investment, meaning they won't ask it from you. So before they lose their money, you'll have to lose yours. You see? Now, when they notice that you entered full margin, at a certain point, they will now start seeing that this guy will lose the whole account. And once they start seeing that the guy will lose the whole account, what do? They kind of start telling you, giving you notification that you're about to blow your account. If you don't close the trade, they will just, you know, blow they will just drop the whole account balance. They take their own um leverage or the money they lended to you. And remember, your small money can't enter the market. Now you will just have a account that is blown. That is how you blow your account. Because if you're playing with investments, it means there is something about losing and winning. Now margin is just that collateral, that how will I say, space from your $50 to, from $1 to $50. Actually, if you have $50 account, you have a potential of buying from $0 or $1 to $50. That is that just the margin level. That is how I can explain margin. Now the next time, order types. When you are opening the market, when you're trading, now we have order types. Now this is the part of trading whereby we are talking about someone executing. For example, you want to buy and sell. You are seeing the market reach a certain point. Now you want to take a short position. We have buying, short, longing, and going up. Those are one thing. We have selling, shorting, going down. Those are one. Those are just still the same thing. Now buy stop. And this was one of the questions that one person asked me, and that person is already trading the real markets, meaning he didn't go through the beginner session very well, and that is the main reason why you need this. When you are taking a buy stop, you are anticipating that, for example, the market is going up, and you are anticipating that when the market reaches this price, it will continue going up. Meaning, if the market reaches that price and reverses at that point, opening your trade and it hits your stop loss, or for example, we'll also talk about stop loss, but as it sounds, stop loss, it stops you from losing, and it hits your stop loss, you'll be out of that trade negative, meaning you'll have lost that trade. Sell stop means you anticipating that when the market will come from, will be going down and hit that position, it will continue going down, it will go down further. That is your anticipation. Okay. Now buy limit is, you mean that when the market reaches a certain point, you anticipate that the market will continue to move. When the market is going down, you say that when the market reaches this price, it will come, reverse at from it, and go up. Sell limit, you mean that when the market comes at this point, it will come, open my position, but will continue going down. And it is as it seems on the pictures, you can see it. That is just the clear definition, but we will continue seeing it on the live charts. This is just an explanation. Take profit. This is the point where you close your trade. Like for example, your trade has been going, and let's say you only want to catch 100 pips. Remember, you only want to move the market to move from your starting point 100 pip above or 100 pip below. Now you put your trade, take profit at that point. Once the market reaches at that point, it's you like you telling the broker that market, once the market reaches at this point, you want to close it, you want to leave that trade. Stop loss is whereby you put your entry at a certain position. Let's say you're buying and you put your take profit 100 pips, but you're telling the broker, because remember, the market just does this thing, meaning it might go against you. Now you're telling the broker, for example, if the market goes against me, I want me to leave this point with a loss. And this is very convenient. Remember, as I said, the market will just do whatever it wants. So I'll always advise when you're trading, put in your stop loss so that you can stop losing. You will lose, okay, but you will have more chances than losing. There is something I used to tell my friend, that instead of you taking one trade and losing the whole account, you can just split your account into certain parts. And that is another part that we'll be talking about, called risk management, which will not be, I think, will be in next week's session. Now, I think now that is the end of today's lesson. But I think that is just like the end of it. But we want to go to the real markets now to start applying this. First things, we'll go and learn how to, where we trade the market, how do we open trades, and how do we connect our brokers. Now, that is the end of it. So I'll be leaving here, and we'll now be going to the next part, which is now the most crucial part. Now, as you'll be trading, you'll come to understand that there is something in the market that is called now these are the essential things that you'll need when you're trading. We'll need MT4, MT5, and trading view. Now, what is the purpose of MT4? MT4 is, this is the point where the broker now connects you to opening the market. Now, this is like the real market. Okay, this is just the market, as you can see it. Now this is the market, so this is where we do take our trades. I don't know if it will load now, but this is just the place where we'll take our trades. Remember, it's on a Saturday, so the market is closed. As I told you, the market is 24/5 market. So after some time, you just see the market as closing. Now that is the main reason we are just loading. Now this is MT4. This is, you can also chat with this, meaning you can analyze here, but I'll advise you not to analyze here, because there is a reason why we don't analyze here. MT4 or rather MT5 do have limited resources for chatting. Chatting is the analysis process. It has a limited resources of chatting. Now that is why we use trading view. There are people that we, as you continue, you will get to know this. Very many, we have very many chatting uh, platforms. This is trading view, the chatting platform that I was telling you that I do use, and I personally like it because it is as simple. So it is more advanced, and if you look to become professional at it, it is very convenient. As you can see, that is how it is. Okay, I'd seen this trade either way, it's okay. So that is how it is. And so MT4, if you want to install it, it is on Google Play. Just come on your Play Store, search for MT4, which means MetaTrader. Search MT4, you can install. And you see, we also have MT5. There are brokers which also have their chatting platforms or trading platforms. We have like XNES, which is also a very good broker, which has its chatting platform. Also FBS as is chatting platform. Here is it, FBS Trader. It has a chatting platform. Now it means if you are using this broker, it doesn't, you don't have to necessarily have to install things like MT4. but I do advise people to install MT4 because it is more of straightforward. Yeah, straightforward. Now the difference between MT4 and MT5 is this: MT4 is the old version. If you can see, let me show you MT5. You see, MT5 is more of this was me just trying to analyze volatility 75, and we will continue saying MT4 is more MT5 is more of a improved area. You can see it is very improved and it's very simple on MT4, but MT5, this is MT5, but when you're trading MT4, but when you are on MT4, you see it is very old, like it has an old-fashioned way. So MT4 is a long time, and MT5 is the new broker terminal. Now these are called broker terminals. These are just the terminals whereby they connect you with the real market. Now this is where you can place your trades and so on and so forth. Now this now what I have equity is, you will see it is the same as balance currently, because we don't have any open trades. We have free margin is now what I was telling you, margin. As you open trade, the free margin will continue to reduce. It is showing you how many trades you can open as you continue, how many positions can you open, because there is a difference. When someone has $10, there is a difference in trades that they can open, from someone who is having $100. Now that is the difference from it all. Now we will go to trading view, and we will see what we were just saying. Now we will go to talking more of candlesticks and so on and so forth. Why does the market look like this? Let me look for a cleaner market. Let me like now go just for gold. Actually, that is not as clean as I thought. I think I've never analyzed Bitcoin. Now, yeah, you can see this is the market. When you're trading on TradingView, there are different things. TradingView is different on very many platforms, but I don't think I know how to explain it. But as you continue chatting with TradingView, you'll continue to understand it. This is the drawing section where you have the tools which I was telling you, and it has a wide variety of tools as compared to, let me show you, as compared to MT4 or MT5. You will see something on MT5. It has a limited number of analysis tools. Let me show you here. As you can see on TradingView, on MT5 we just have this one, but on TradingView we have more improved analysis. You see, we have many things. So, and also it has a section whereby the ones that you use, you can star them or favorite them so that you can get to access them faster. You see, now this is the tab of which carries all the tools that I use. Now these are just candlestick are just a graphical representation of data as per the time frame, meaning every candle here, as you can see down here, we are on the 4-hour time frame, meaning every candlestick here represents 4 hours, meaning every candle here closes after 4 hours. You see, Bitcoin actually, cryptocurrencies do trade 24/7. So you can see that Bitcoin, we have 5 hours, 5 minutes before this candle closes. But you'll see one thing, when I go to like the 1 minute time frame, you'll see we'll have very many candles. And let me show you something. After 25 seconds, you'll see this candlestick closing, and we'll be opening another candlestick. Wait, in 19, 18, 17 seconds, we will see we'll be opening another candlestick. Let me show you. 8, 7, 6, 5, 4, 3, 2, 1. You see, it closed that candlestick that way and open another candlestick. If you can see this green thing that has formed here, that is now another candlestick, meaning every candlestick in this time frame, in the 1 minute time frame, represents the 1 minute. But if you can see on the 4 hour time frame, that candlestick that we still had hasn't closed, meaning that is just the main purpose of the time frame. They just give you a larger representation of the market, because remember, if I want to start analyzing from 2022, I can't start doing it on the 1 minute if every candle represents 1 minute, meaning this is 1 minute. Let me show you. This is 1 minute, this is another minute, this is another minute, this is another minute. You'll see that this is just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 from here to here, that is already 10 minutes. How can I start analyzing from 2022 with 1 minute time frame? So that is what I do. If you can see, we have closed that candlestick that way. Now we have opened another candlestick. Now what do I do if I want to start analyzing from a larger time frame? I start from the 4 hour time frame. I go to the 4 hour time frame, then I analyze from here. If you can see on the 4 hour time frame, this is the 1st of February, and we are currently on the 3rd of the February. Now 10 candlesticks behind is just the start of the 1st February. But remember, the 1 minute time frame, 10 candlestick behind was 10 minutes before. You see, now that is the difference between time frames. Now another thing that we also have to learn, now these are the currency pairs that I was talking about. If you see, you have XAU USD, BTC USDT, that is Tether USD, and we'll continue learning as time goes by. Another thing that I think we might also understand is, you know, this is just the interface of TradingView. I had not planned on teaching on TradingView today, but let me just um finish on it. This is just the interface on TradingView. The main points are the drawing tools. This actually represents assets, meaning once you click on here, it will be added to your watch list. Watch list is where a minute. Sorry for that. So these are just, once you click on it, it will be added to your watch list. So watch list are the pairs that you only want to look at, because as you continue, you'll understand that you can't just look at everything. You'll need some pairs that you'll be looking at a certain period of time or forever. For example, as for me, I decided to only stick on oil only, that nothing else. uh, After this, we have indicators. These are now indicators do analyze every price movement, and then they give you a graphical representation. After we do learn about strategy and we get to a point of trading on the real markets, now we will go back and start understanding what these indicators do mean, because if we start talking about them now, they might confuse us as on the way. Either way, even we will talk about this is part of technical analysis. And at this point, if you are looking at Bitcoin at this point, I think you should be looking to buy at this point. Let me show you something for now. 425. So I think we should be looking to buy, if we're looking at Bitcoin USDT, you should be looking to buy at this area for 3 4 3 1 2 3. You should be looking to buy at this area. And if you're looking at it, you can just check on it after some time, and you'll give me your feedback after some time. So you should be looking to buy it from there, and you can hold it to, somewhere here. Now these are the analysis that we do use on, you know, to understand how the market is moving. You'll hear that after some time the Bitcoin dropped, and this was here. Bitcoin was dropping, and it started bringing panic on people who are not technical analysis. You see, Bitcoin was dropping, and now we have started going up. So if you are keen, you can hold it until that point, but if it breaks above that, then it is okay. Now one thing I don't trade about Bitcoin is, if you're trading a certain pair, you should understand it. You should understand how it works. You should understand why it moves that way, so that you know you can be on the safe side on it. Because if you don't understand it, you won't know why it is moving that way. Who does trade this pair? Who doesn't trade this pair? Why should you not be trading this pair? Why should you be trading this pair? These are things that you should understand. Now I don't trade Bitcoin because I don't like the crypto aspect. Crypto is more of, you know, it is not backed by the government, meaning at any time it can just jump inside it once. Now that is why you'll see me trading oil, because oil actually is backed up with very many government institutions. So on oil we might start having a push from here. Let me look at my smaller time frame. We might start having a push from here to somewhere here, but I'll talk about the push on Monday. So that is just it for today. So I've learned about the basic. Now what we tomorrow will be looking at, we'll look at the candlestick technical analysis part of it. We'll be learning about candlestick. We'll be learning about you know, trend lines, what are trend lines, what are support and resistance, and so on and so forth. Then the other on Monday maybe we'll be looking at, you know, how to form a strategy, and we'll be trading the wise pips um trading strategy, and we will learn it from there. And once we learn it from there, we'll now start looking on risk management. After that, we'll start looking on, you know, money management, and then we'll get into practicing. Now we'll be now going live, just practicing what we have learned, and after that, it just that is. Anyway, see you next time, and hope we meet tomorrow again. So maybe if you have a question, you can just ask. If you have a question, let me put it that way. If you have a question, you can just ask. So I think I'll just finish there. If you have a question, you can just put it on the group chat, and we will talk about it more. That way, see you guys in the next video. Bye.